Welcome back to Retired with a Full Heart at Home. I'm Erica.
I'm Jack.
And a couple of weeks ago, we did a video on the 7 things we did that financial advisors would hate. And we did get 2 questions from that video that we thought we'd answer in this video because they were good questions. And we did fail to address these in that previous video. So the first question was, what are we doing with the money we're taking out of our employee traditional 401k retirement account? We said we were drawing down on it and they want to know what we're doing with it. And then also they were curious about how the balance of the 401k is changing given we're paying the taxes on that money. So, you ready?
Sure.
Okay. So before we get into the details of what we're doing with money, we just want to say we are not financial advisors.
No.
And we're just sharing our experience, our opinions, and you know what they say about opinions, and given our unique situation, which our risk tolerance and other people's risk tolerance are different.
Yeah, one of the reasons we're making this video, not just to address the questions, but we hope to encourage other people to try out retirement. Take what we say with a grain of salt. I would say on the other hand, we're not financial advisors, so we're not trying to reach into your pockets and take your money.
Very good point. The way we're doing this is, as we said in the video, is that we're drawing down on employer 401k and we're paying the taxes because it is a traditional 401k. And then we're taking that money and we're investing it. This is not happening overnight.
No.
This is going to take us until our mid-60s to draw down on our 401k so that we do it in a smart way and stay in our tax bracket. So we don't trigger a higher tax bracket. Okay, so here's a plot of the 2 employer 401k
Funds?
The blue fund is Jack's and the orange fund is mine. And I set the value of the plot to 100% the day of retirement, just so that it would be easier for you all to read it, because then you can see the percentage up and down of the account. The absolute value of the number doesn't really matter. It's more like, what have we done and how much of a percentage change has that made in the account? So I set it to 100%, and you can see from the orange plot that we took a distribution from my account, because I retired about a year earlier than Jack, and we paid the taxes, and then we opened a brokerage account. And Jack picked 2 ETFs he's going to talk about to invest in. And then we left my account in, as it was when I retired, in treasury bonds. We left my employee 401k, the balance of it, in treasury bonds. And so you can see in the orange plot that the treasury bond growth has been steady, but really tiny. So it's grown back to about 85% of what I had at retirement over the last couple of years, which is good. It's gone from about 78 to about 85%. So what's that, about 7% increase over a couple years?
And the beauty of that account is that it will never go down by 1 penny.
That's right.
There's
and that's
no
what
stress.
I love about it. I've always loved about it. Anyways, so if you look at the blue curve, Jack,
Yeah, what the hell's going on with that? That thing's all over the place.
Jack,
That's like a squirrel gone crazy. What the hell?
that fits you, okay? I'm steady Eddie, just very
Yeah.
linear, and you're like, I
Who
never
wants
know what
that
you're
roller coaster?
That's right. So anyway, the blue curve is yours, it's Jack's, and he took a distribution in the second year, which was the first year of his retirement, and we paid the taxes. And then he also, pretty much simultaneously though, he transitioned his 401k from bonds, from treasury bonds, into a stock fund our employer offered that is an index fund that tracks the S&P 500. And you just went all in. You went 100% stocks.
What the hell?
Yeah.
Again, because we have pensions
See, I gave
that
him
we
a
live
little
off
bit of
of.
room, and he went like,
Just went crazy with it.
yeah, that's right.
Bought a Corvette. No.
No, at least you didn't do that. So anyway, he allocated 100% at the same time to stocks, and joke's on me, because look at your account, hon.
At the moment.
At the moment,
Yeah.
your account is back to where it was when a little over where it was when you retired.
Right.
Even though you took a sizable lump sum
Yes.
distribution.
And I am
paid
certain
tax.
it will never go down.
That's not true.
That's not true at all.
2 months ago.
It could all
was-
be gone.
2 months ago, you
It
lost
got
all the gains of a year and a half, right? So you got to live with the volatility. Anyways, so he has recovered. I mean, by today's numbers, he's recovered all of the amount that he took out plus the taxes. So where we sit today in those two accounts combined, we have about 53% in stocks and about 47% in bonds. So about 50-50 roughly. Okay. So the first question, what are we doing with the money we're taking out of our 401k? All right, so Jack, you want to?
We're putting our money into ETFs, or just index funds, and both of them mostly track stocks in the U.S. stock market. That's what we're most comfortable with. And both of them are run by Vanguard, which has very low fees. We like these index funds because they're passively managed, they're not actively managed, which means there's very little churning of the accounts. There aren't unnecessary fees being racked up in commissions. And we like the fact that it's diversified. ETFs we own, one of them has 170 stocks, and the other ETF has like around 300 stocks in its holdings. And we like that diversification, that broad search across the stock market, just for the safety of it. We're not dependent on a single stock that might fail.
Yep, that's it. And we took those two lump sum distributions and again deposited them in a brokerage account. And you can see in the plot how the balance of the brokerage account has changed over time. And that is that in that brokerage account by itself, it's about 75% stocks, or those ETFs. And we did I bought a small bond, and it's 25% bond allocation in there. So it's sitting there. Okay, so taking all three of those accounts, the two employer 401ks, I don't know why I'm stumbling on that so much, and the brokerage account, we are up by, you can see in the plot here, about 20% over almost 3 years from where we were at the start of retirement. So I was surprised.
Not too shabby.
Actually, I wasn't surprised because I do our net worth every month, but just seeing it isolated to this was interesting. So we're up over 20%, which is a little more than 6% per year. Nothing to brag about. We're definitely not bragging. And
We're basically day traders. 6% a year. How did they do it?
it's not stunning performance by any means.
No, but we're really trying to, correct me if I'm wrong. I mean, I think what we're trying to do is keep up with inflation.
Yeah.
And this is doing that.
We're really trying to preserve our principal and keep up with inflation. So anything above that, and we're thrilled,
Yeah.
right? So again, all three accounts combined put us at about 58% stock and about 42% bonds. So I would not call that high risk.
No.
I don't think at all. And so we're getting ready to do our third lump sum distribution now that the taxes are done for 2024. And we've done our projection for 2025. We know how much we could take and stay in our tax bracket. So we're getting ready to do another one, and I think on this one we're going to go all in on stocks, and that'll put us at about 69% stocks and 31% bonds. So really 70-30. And I'm not really sure where we're going to go after that. I know you would be happy if at the end we were 100% stocks.
Sure.
But I've come a long way, baby. You know, from like no stocks to 70. You know, if we go 70%, that's quite risk tolerant.
That's fine.
For me.
Sure.
We could take on more risk because we don't need the money to live on month over month.
Yeah.
But we do need the money. So there are things that get paid out of that bucket that we really need the money for. So I'm a little reluctant to go all in on stocks and be forced to maybe sell in a downturn. So anyways, I hope we answered the questions.
Yeah, I don't know if you want to include this. This is just like a stray thought.
Okay.
I know this whole video is about money.
Yeah.
But money only gets you so far. And the funny thing about money, we heard someone mention, is that no matter what your financial goalpost is, once you reach that milestone, that financial milestone, a new one pops up, and then you reach it, and a new one pops up.
Yeah.
And so you're always chasing that next milestone.
That's true.
And one of the things like that we found helpful is to just kind of pause, and the beautiful thing about retirement is to be able to like just appreciate and be content with what we've got.
Yeah.
Videos about money, and
Yeah.
money is definitely important. Definitely taught that to our children, that it's important, but also your mindset's important, and to allow yourself to just feel content and satisfied with where you're at, and to stop. Get off the gerbil wheel.
Yeah, declare success.
Of course, you like to sometimes say pencils down.
Pencils down. Well,
No? Is
Not
it
in
not in this
one.
context?
Yeah.
Okay.
Anyway.
Keep your pencils up. Don't put that pencil down. There's money to be made. Okay, Mr. Ebenezer.
Can I have another piece of coal?
Bring me my quill.
Anyway, we gotta end. We gotta land this, right? Oh, thanks, hon. So we just wanted to answer the questions, and we also, if there's anybody out there that's disturbed by
Our videos.
drawing out of your traditional 401k and paying
yes,
taxes,
yes.
we did that, and we're still up 20%.
Yes.
With a relatively normal, I would say most people have a portfolio similar to ours. You know, we were very, very low risk.
Yeah.
Typical to the general public. So maybe it isn't as bad as all that. And we hope that helped, and we hope you have a great day, and we hope to see you in the next video. If you have any more questions for us, let us know. We'll either answer them in the comments if we can, or we'll make another video. Anyway, thanks so much.
Thank you.